Hello, everybody. My name is Joe Allaria, and I'm a partner and wealth advisor with Carson Allaria Wealth Management. Today, I am coming to you to talk about bonds and what bonds have done in 2022, as it's been a very, very tough start to the year. And I want to share something that was put out by BlackRock. It's called Student of the Market, and it is the May edition. And I thought there was some really good information and really perspective on bonds. So I want to just jump right into that and look at that. So here it is. You can look this up if you'd like, Student of the Market from BlackRock. But I'd like to start here. And the bad news is, unfortunately, 2022, believe it or not, it's the worst ever start to a year for bonds, if you can believe that. A worst ever start, which is sort of hard to believe. But you can see the information here. In 2022, down 9.5%. And they're looking at the ag bond index here this year, but worst start ever to bonds. And that goes back to 1926. So it's pretty significant data. Now, on the right side, it shows returns following, though, the 10 worst starts to a year since 1926. And they have returns for the next 8 months and returns for the next 12 months. So the good news, which you can't say that we know what the future holds just based on past performance, but it does give us this amount of data, a very good idea, or at least a good reason for hope on what's to come in the future. But if you look at these returns, all the negatives in the first 4 months, and then every single one, the next 8 months, every single period was positive. And then if you look at the next 12 months, we had some that were positive. There was actually one that turned negative. So in 2021, if you recall, the first 4 months, bonds were down. The next 8 months, bonds were up. But surprise, surprise, that 12-month period includes 2022, which is, again, the worst start to a year. So, but by and large, you can see the return numbers. Not only are they positive, but they're pretty strong, especially for bonds. So if you've heard about bonds, you've seen your portfolio value and you're wondering, why is it down so much? You might not even be a very aggressive investor. And I've talked to folks like that that are in 401ks and a couple clients, but mostly folks I talk to in 401k plans that we advise on, and they're wondering, why is my account down? I didn't think I was very aggressive. Well, stocks are down and bonds are down as well. Next page, I want to show this kind of goes to and shows more of the longer term, the midterm activity of bonds. So how long do you need to give bonds to expect a positive return, or a very high probability of a positive return? Well, this chart says that 70% of 1 month periods showed a positive return in bonds. But if you stretch that to 6 months, that percentage goes up to 83. 83% of 6 month periods were positive in bonds. 1 year, 90%. 99% on every 3-year period. They looking at every 3-year rolling period. 99% of those had a positive return for bonds. You go to 4 years, 5 years, 100%. So what does that tell us? Well, we need to, when we invest in bonds, we personally look at bonds as that 2 to 9 year bucket. So you can see here, why do we do that? Well, again, 1 year, 90% of 1 year periods were positive in bonds, and 3 years is 99%. So suffice it to say that 2 years, somewhere in the middle, right? 90 something percent of the time, 2 year periods are positive. It's a pretty high probability. And then we go to 3 years, 4 years, 5 years, 6 years, the probability is extremely high. That's why we use that as our philosophy. And that should give you some hope on, again, what's to come. If we've seen the worst 4 months to the start of the year, what is the probability that we're going to see that continue? And then what is the probability that it would rebound? Well, based on the data, we could see that at some point, we don't know when, but we do believe that bonds will rebound and you'll see better returns because we've been in such a poor period in bonds the first 4 months of the year. So right now, if you look at the last 1 year return, it's negative in bonds going back a year. So we're in that 10%. And it's actually been the second worst 1 year time period that we're in right now, is the second worst ever out of 1145. It's the worst period since March of 1980, which was the worst ever. So again, perspective, I'm not saying it's good news, but again, if you look at the 3-year periods, bonds are positive. 4 years, 5 years, bonds are still positive. And this is a bond index. So depending on what kind of bonds you're in, that would determine how your bonds have done. So if you're watching this and you're in, some like a bond index or a target date fund, that's going to be more closer to the ag index. And sometimes that's all that's offered in a 401k. So those have been hurt more than some other bonds where maybe you take something called duration and lower that duration and basically make your bonds less sensitive to interest rates, which is something that we have done on the individual side of our business for clients where we're actually managing the bond portfolio for them and the stock portfolio. So again, just more information here, but following the worst 1 year price returns for bonds, you could see since 1926, the average 1 year return in bonds was 15.5%, and average stock returns 13%. This is not, again, I can't say this is a prediction and that this is definitely going to happen again, but it does give us a lot of data and some reason to be optimistic about the future. And I would even say the somewhat near-term future, but we always have to prepare when you're investing in stocks and bonds. You always have to prepare for extended down periods, extended periods of challenging times. And when you invest in stocks, you need to have that 10-year hat on, that 10-year mindset for stocks. When you invest in bonds, you need to have that 2 to 9 year mindset. So right now we're 1 year in. So we shouldn't panic at any point. But we have a whole year until we're at 2 years into, again, bonds being down. And year to date, we're only about 4.5 months in at this point. So the thing is to remember, we have to give it time. This is how investing is done. There are ups, there are downs. Unfortunately, we don't see consistent ups every year, every 1 year, every 3 years. History shows we've seen them every 4 and 5 years in bonds, but investing in general in stocks and bonds, that the market goes up and it goes down. So make sure you're reviewing your financial plan, your retirement plan. If you're a client of ours, you have one of those. If you are not, we encourage you, get a plan in place so that you can, rely on that, lean back on that. And a lot of times the plans will project out the portfolio value at future ages. And so look at the value at your life expectancy or at age 100 or however long your plan goes out to. And in times like this, that's sometimes the best exercise. Look at that number. And that number, maybe before, if you're retired now, maybe that number was 2.3 million. And now maybe it's 2.1 million because the market's down a little bit and we've had these, bonds are down, stocks are down. You might have been a lot more worried. And then you look at that and see, well, geez, what difference does that really make? So again, that's not a guarantee. Everyone's situation is different. But oftentimes when you look at your plan, I believe that these short-term challenges that we have, they don't seem to have as big of an effect on the long-term plan as some people think they might. So with that, I'm going to cut this video off, and I appreciate you watching. Please, if you're watching this on YouTube, visit our website, carsonalaria.com. You can see podcasts, blog posts, more information, webinars, a lot of resources on there. And if you're not watching this on YouTube, go to YouTube. We have other videos that you can tune into as well. And you can also sign up for our newsletter called The Wealth Navigator, and we can send that directly to your inbox every month. All right, guys. Well, hang in there. If you're watching this right now, it's May 13th, 2022. So hang in there. We believe this too shall pass, but I thought this was some good information for you. With that, have a great day and look forward to talking to you soon. Bye-bye.